Right now, as you're watching this video, the silver market is being flooded with one sentence. Mexico just banned silver exports. You've seen it on social media, you've seen it in comments, you've seen thumbnails screaming collapse, shortages, panic. Some people are calling it fake news. Others are calling it hysteria. Most are scrolling past it, assuming it will be debunked and forgotten like every other commodity scare. That reaction is exactly why this matters, because the truth is far more dangerous than the rumor. Mexico did not wake up one morning and announce a dramatic export ban. There were no soldiers at ports, no emergency decrees, no televised announcement. What's happening is quieter, slower, and much harder to reverse. Let me show you. To understand why this is a supply shock, you need to understand Mexico's role in the silver market. Mexico is not just another producer, it is the producer. Roughly 24% of the world's mined silver comes from Mexico. No other country is even close. China is second, Peru is third. The gap between Mexico and everyone else is enormous. Think about that for a moment. 1 out of every 4 ounces of new silver entering the global market comes from a single country. That means any disruption in Mexico is not regional. It is global. Now, here's the part nobody realized. Mexico didn't need to ban exports to choke supply. They did something far more effective. They stopped the future. Over the last several years, Mexico has quietly frozen new mining concessions. Not temporarily, indefinitely. No new permits, no expansion approvals, no replacement projects. At the same time, environmental restrictions tightened. Open pit mining was effectively killed. Investment approvals slowed to a crawl. On paper, silver exports still exist. In reality, the pipeline that feeds them is drying up. This is what a soft ban looks like. No headlines, no outrage, just attrition. Here's why that matters. Mining is not like manufacturing. You cannot turn it on and off. Silver mines deplete. Grades decline. Production naturally falls unless new projects come online. Mexico's largest silver mines are aging. Some are already past peak output. Others are facing rising costs, security issues, and regulatory pressure. Without new concessions, there is no replacement supply. That means exports today are being supported by mines that have no successors. This already happened before. In other resource-rich countries, governments didn't nationalize mines overnight. They simply made new investment impossible. Production didn't collapse immediately. It bled out over years. By the time markets noticed, it was too late. Now, layer in the second factor no one wants to talk about: security. Large portions of Mexico's silver output move through regions controlled by organized crime. This isn't speculation, it's documented. Mining companies pay fees. Transport is taxed. Metal is diverted. Estimates vary, but industry insiders quietly acknowledge that a meaningful percentage of silver never reaches official export channels. That silver doesn't disappear, it just leaves the transparent market. For global supply, the effect is the same. Those ounces effectively do not exist. Think about that for a moment. Official production numbers assume metal flows cleanly from mine to refinery to market. In reality, a growing share never shows up. This is the third layer of the soft ban. Policy restricts future supply. Security issues siphon current supply. And global demand continues to rise. This is not a theory, it's arithmetic. Here's where the rumor completely misses the point. People are asking, did Mexico ban silver exports? That's the wrong question. The real question is, how much silver will Mexico be exporting 5 years from now? And the answer, based on policy, geology, and security, is less. Much less. This is why markets are reacting even without an official announcement. Silver doesn't care about press releases. It responds to flow. When future flow shrinks, price adjusts early. This already happened before. In oil markets, countries didn't announce shortages. They underinvested. Years later, supply snapped. In uranium, governments restricted permits. A decade later, prices exploded. Silver is following the same pattern. Now add global context. The world is already running a silver deficit. Annual consumption exceeds mine supply. That gap has been filled by above-ground inventories. Those inventories are not infinite. Each year, the deficit continues, buffers shrink. Mexico's soft ban accelerates that process. And there is no alternative supplier waiting in the wings. No country can replace 24% of global supply quickly. Most can't replace it at all. New mines take 10 to 15 years to develop. Permits take longer. Capital is scarce. That means Mexico's decision, intentional or not, locks in future scarcity. This is where elite betrayal enters. Mainstream coverage treats silver as a sideshow, a volatile metal, a speculative asset. Meanwhile, the largest supply source on Earth is slowly closing the door. No emergency alerts, no breaking news banners, just silence. Because acknowledging this would force uncomfortable questions. Questions about energy transition targets, questions about industrial dependency, questions about whether the math still works. It doesn't. Here's the quiet truth. If Mexico had announced an outright export ban, markets would have panicked briefly and then adapted. By doing it this way, the system drifts into shortage without ever fully confronting it. That is far more destabilizing, because by the time the shortage is undeniable, there is nothing left to fix. This is the ticking clock. Mining policy today determines supply years from now. The decisions have already been made, and they are not reversible in market timelines. This is why the rumor matters, even though it's technically wrong. It points at the right outcome for the wrong reason. Mexico didn't ban silver exports. They made future silver exports impossible to sustain. That's worse, because bans can be lifted. Geology and policy cannot be renegotiated quickly. This is not a political story, it's a structural one, and structure always wins. You are not watching a headline-driven panic. You are watching the early recognition of a supply shock that was years in the making. Most people are still arguing about whether the rumor is true. That debate is irrelevant. The supply math has already changed, and once supply math changes, price follows whether anyone agrees or not. This is not about Mexico's intent, it's about Mexico's impact. And that impact is now locked in. The silver market is not reacting to news. It is reacting to inevitability. And this is only the beginning. To understand why Mexico's move matters so much, you have to stop thinking about silver as a commodity and start thinking about it as a flow system. Not sentiment, not price, flow. Here's the part nobody realized. The silver market does not break when production stops. It breaks when replacement stops. That is exactly what Mexico just did. For decades, Mexico functioned as the shock absorber of the global silver market. When other regions underperformed, Mexico compensated. When demand rose, Mexico scaled. That flexibility is gone. Think about that for a moment. Mining supply is not about today's output. It's about the pipeline. And Mexico's pipeline has been quietly sealed off. New concessions are frozen, exploration is stalled, capital has fled. Those facts don't show up in quarterly production numbers. They show up years later when there is nothing left to replace declining mines. This already happened before. In every commodity crisis that mattered, the warning signs were invisible at first. Production looked stable, exports continued, then suddenly they didn't. Silver is now in that exact phase. Here's how the math works. Most of Mexico's silver comes from a handful of mature districts: Fresnillo, Zacatecas, Durango. These are not new discoveries. They're aging assets. Ore grades decline over time. Costs rise. Output falls unless new projects are constantly added. Mexico's policy environment made that impossible. No new permits means no new mines. No new mines means inevitable decline. This is not ideology, it's geology. Now add the second pressure point. Mexico's silver production is not isolated from its security situation. Transport routes are vulnerable. Refining logistics are compromised. Insurance costs are rising. This doesn't shut mines down overnight. It erodes reliability. And reliability is what global supply chains depend on. Every ounce that is delayed, diverted, or lost compounds the deficit. Those ounces do not reappear later. This is where the supply shock becomes unavoidable. Global silver demand is not waiting for Mexico to sort this out. Solar manufacturing continues to expand. Electrification accelerates. Defense procurement intensifies. All of these consume silver continuously. There is no pause button. Think about that for a moment. Demand is locked in by policy and contracts. Supply is constrained by geology and regulation. That imbalance is not cyclical, it is structural. This is why the rumor about an export ban spread so fast. Markets sensed the imbalance before the explanation arrived. Price often reacts before narrative catches up. This already happened before. In uranium, prices moved years before governments acknowledged supply problems. In oil, prices surged long before underinvestment was publicly admitted. Silver is doing the same thing now. The difference is scale. Mexico is not a marginal supplier. It is the backbone. When the backbone weakens, the entire system compensates. And compensation in commodities means higher prices and tighter access. Here's where the soft ban concept becomes critical. An outright export ban would have been disruptive but temporary. Policy pressure could reverse it. What Mexico implemented is far more durable. By freezing future supply, they locked in scarcity without triggering immediate backlash. There is no single decision to undo, no decree to repeal. Rebuilding the pipeline would take a decade, even if policy reversed tomorrow. That means the supply shock is already baked in. Markets are forward-looking. They price future scarcity early. That's what you're seeing now. Now consider global alternatives. Could another country step in? China already consumes much of its own production. Peru faces similar regulatory and social constraints. Australia's silver output is limited and mostly byproduct. There is no spare capacity waiting. This is the hidden trap of byproduct metals. Because silver is often mined alongside other metals, Production does not respond directly to silver prices. Even at higher prices, output doesn't surge. That makes deficits persistent. This is where the historical trauma echo matters. In past commodity squeezes, markets assumed higher prices would fix supply. They didn't. In nickel, in uranium, in rare earths. Silver is no different. Price can ration demand, but it cannot create metal. This is why the system is nervous. Here's the quiet control narrative. Institutions are not publicly panicking. They are adjusting quietly. Long-term contracts are being signed. Inventories are being secured. Supply chains are being hardened. This behavior never shows up in headlines. It shows up later when availability disappears. By the time retail notices shortages, the metal is already allocated. This is the shame loop. You were told silver was plentiful. You were told supply was flexible. You were told Mexico was stable. Those beliefs were convenient. They are no longer accurate. Now, look at timing. Mining decisions made today determine supply 5 to 10 years from now. Mexico's decisions are already several years old. The consequences are just now emerging. This is why the reaction feels sudden. It isn't. It's delayed. Delayed reactions are always more violent because there is no time to adjust. That's the ticking clock. The window to fix this closed quietly. What remains is adaptation. Adaptation in commodity markets means higher prices, restricted access, and strategic prioritization. This is the coming reset. Not a crash, a reordering. Silver shifts from being available at a price to available with priority. That distinction matters. Once priority systems emerge, markets fragment, paper prices and physical prices diverge, premiums expand, delivery times lengthen. This already happened before. In every market where supply became strategic, access replaced liquidity. Oil in the 1970s, uranium in the 2000s, food commodities during crises. Silver is joining that list. Here's the uncomfortable reality. Mexico didn't need to ban exports to change the world silver market. They only needed to stop planning for the future. That's what they did. And because mining operates on long timelines, the consequences are now unavoidable. You are not watching a policy debate. You are watching the lagged effect of decisions already made. The rumor got the headline wrong, but it pointed in the right direction. The silver market is entering a supply-constrained era, and once supply constraints become visible, price does not negotiate. It enforces. This is why Part 2 matters. It explains why this shock did not start today. It started years ago, and why nothing short of a decade-long policy reversal can change the outcome now. The system can deny it. It can downplay it. It can delay recognition, but it cannot change the math. And the math is already in motion. Mexico didn't flip a switch. They removed the future. The market is only now realizing what that means. Every market shock looks survivable at first, until you measure it against what no longer exists. Here's the part nobody realized. The silver market does not have slack. For years, deficits were masked by above-ground inventories and paper liquidity. Metal moved when needed. Delivery still happened. That cushion is gone. Think about that for a moment. A market can survive falling production if it has buffers. It cannot survive falling production and rising demand when buffers are already depleted. That is the condition silver is in now. This is why Mexico's soft ban is not just another supply issue. It hits a market that has already been running in the red. Global silver consumption has exceeded mine supply for multiple consecutive years. The difference was covered by stockpiles. Those stockpiles were never meant to support permanent deficits. They were meant to smooth volatility. They are now being consumed structurally. This already happened before. In every historical shortage that mattered, the critical moment was not when supply declined. It was when inventories stopped acting as shock absorbers. Oil in the 1970s, grain during food crises, uranium in the 2000s. Once inventories thin, price becomes violent because there is nothing left to buffer demand. Silver has crossed that line. Here's where Mexico becomes the catalyst. Mexico is not reducing supply from abundance. It is reducing supply from scarcity. When a quarter of global production becomes uncertain in a tight market, the system cannot compensate. There is nowhere to source replacement metal. Think about that. No emergency stockpile exists for silver. No strategic reserve is large enough to matter. No idle mines can be restarted quickly. This is not like oil, where spare capacity exists. This is not like gold, where above-ground stocks are massive. Silver is different. Most silver ever mined is gone, consumed, dispersed. That makes every ounce coming out of the ground disproportionately important. Now look at the demand side. Again, industrial demand is not slowing, it is accelerating. Solar installations continue to rise globally. Electric vehicles scale year after year. Defense electronics demand increases as geopolitical tension rises. None of these sectors reduce consumption because prices go up. They lock contracts earlier. That creates front-loaded demand. This is the doom mechanism. As supply tightens, buyers accelerate purchases to avoid future shortages. Acceleration tightens supply further. That feedback loop feeds itself. This is why shortages do not resolve calmly. They escalate. Mexico's policy environment guarantees that supply cannot respond to this loop. Even if prices triple, new mines will not appear overnight. Even if investment returns, permits will not be granted quickly. Even if security improves, geology does not. The lag is built in. This is where paper markets lose relevance. Paper markets assume elasticity. They assume futures prices can coax supply forward or push demand back. That assumption breaks when demand is compulsory. Once that happens, paper markets stop clearing reality. They start obscuring it. This is why physical premiums rise while spot prices appear calm. This is why delivery times extend without announcements. This is why exchanges quietly adjust rules. Those are stress responses, not confidence signals. This already happened before. In every market where physical supply dominated, futures markets became secondary. Price discovery shifted away from screens toward contracts and allocations. Silver is moving in that direction now. Mexico accelerates this transition. By constraining future supply, it forces buyers to rethink sourcing strategies today. They don't wait for shortages to be confirmed. They preempt them. That behavior removes metal from circulation earlier than expected. This is why supply shocks feel sudden. They are anticipatory. Here's the part that should concern you most. Even if Mexico reversed course tomorrow, the damage is done. Exploration timelines cannot be compressed. Capital cannot move instantly. Permitting cannot be rushed. Mining is slow by design. That means the silver market is now pricing a future that cannot be avoided. This is why comparisons to temporary export bans are misleading. This is not about a policy headline. It is about a lost decade of supply development. Markets do not forgive that. They price it in full. This is also why institutional behavior is changing. Large buyers are no longer relying on spot markets. They are securing long-term contracts. They are diversifying supply chains where possible. This activity never shows up in retail narratives, but it determines availability. Once those contracts are signed, metal is spoken for. That reduces float. Reduced float increases volatility. Volatility scares remaining sellers. This is the chain reaction. Mexico is not acting in isolation. It is acting at the worst possible moment in the cycle, a moment when silver cannot afford to lose even marginal supply. That is why this shock cannot be absorbed. There is no margin for error left. Think about that for a moment. Markets survive mistakes when they have room. They break when they don't. Silver doesn't. This is the ticking clock. Raise, drain further. When demand locks in, by 2026 or 27, the consequences become impossible to hide. This is not speculation. It is timeline math. Mexico's actions shorten that timeline. This is why the market reaction feels disproportionate. It's not reacting to a rumor, it's reacting to confirmation that a fragile system just lost its largest stabilizer. That stabilizer was Mexico's ability to replace declining supply. That ability is gone, and once replacement stops, shortages do not negotiate. They enforce. This is where elite betrayal completes. Public narratives will continue to downplay silver's importance. Officials will reassure markets. Commentators will argue about price targets. Meanwhile, supply chains will harden quietly. That divergence always ends the same way. Suddenly, when availability becomes the headline. By then, it's too late to reposition calmly. This is why understanding Part 3 matters. It explains why this is not a transient shock. It is a structural failure. And structural failures do not reverse without rebuilding. Rebuilding takes time. Time the silver market no longer has. Mexico didn't just constrain supply. It removed the margin of safety. And once a market loses its margin of safety, every shock becomes systemic. This one already is. The only question now is how quickly the rest of the world is forced to acknowledge it. Because the metal doesn't wait for consensus. It just runs out. Every resource market reaches a final stage where the question stops being price and becomes control. Not control of narratives, control of flow. This is where silver is heading now. Here's the part nobody wants to confront. Once a market realizes supply cannot be expanded in time, it stops behaving like a market. It starts behaving like a rationing system. That transition is already underway. Mexico's role in this is not symbolic. It is decisive. When the largest supplier of a critical material quietly removes its future capacity, the rest of the system is forced to adapt immediately, even if the public explanation lags behind. That adaptation is what you are watching now. This already happened before. In every historical case where a resource became strategically constrained, the endgame followed the same pattern. First, denial. Then, quiet adjustment. Finally, open competition for access. Silver is moving from the second phase into the third. Think about that for a moment. Price is a signal only when supply is flexible. When supply is rigid, price becomes a weapon. It is used to ration demand, not discover value. That is the phase silver is entering. Here's the hidden shift most people miss. As supply tightens, the market stops asking, who will pay the most? It starts asking, who cannot operate without this? That question changes allocation completely. Industries that can substitute will be priced out. Industries that cannot will pay whatever is required. This is not speculation. It is survival logic. Silver is now firmly in that category. Solar manufacturers cannot redesign panels overnight. EV producers cannot re-engineer supply chains on demand. Defense contractors cannot accept shortages. They secure supply first and argue about cost later. This behavior is already visible. Long-term offtake agreements are expanding. Private contracts bypass exchanges. Metal disappears from open markets. Every ounce locked into these agreements is an ounce that will never respond to spot price signals again. That is the irreversible part. Once supply is spoken for, markets fragment. Paper prices still exist, but they no longer represent availability. This already happened before. In energy markets, futures prices often lag physical shortages. In food markets, price controls masked scarcity until shelves emptied. Silver is not immune to this dynamic. In fact, it is more vulnerable because inventories are smaller and consumption is continuous. Now consider the geopolitical dimension. As silver becomes scarce, producing nations gain leverage, not through announcements, through silence. Mexico does not need to threaten anyone. Its geology does the work. By constraining supply, Mexico shifts bargaining power without saying a word. This is supply as power, and supply-based power is far more durable than policy. You cannot sanction geology. You cannot negotiate with ore grades. You cannot fast-track physics. That is why this matters beyond silver investors. This affects energy transition plans, defense readiness, infrastructure resilience. Any system that assumed abundant silver is now exposed. This is where elite betrayal becomes unavoidable. Public policy continues to promise electrification, decarbonization, and technological scaling. Those promises assume materials will appear on schedule. Mexico's actions prove that assumption false. But admitting that would force a reckoning no institution wants to face, so the narrative stays optimistic. The math deteriorates. That divergence always ends the same way, abruptly. Here's the final mechanism. As scarcity becomes undeniable, governments step in, not to fix supply, to manage consequences. Export controls appear quietly. Strategic classifications expand. Priority allocations replace open markets. This is not a conspiracy. It is standard crisis behavior. When something becomes essential, it stops being free. Silver is moving into that category. This is why the question of whether Mexico banned exports misses the point entirely. Bans are temporary. Structural scarcity is permanent. Once silver is treated as strategic, access becomes conditional. Who gets metal depends on national priorities, not market bids. That is the real reset. Not a crash, a reordering. This already happened before. Oil, after the 1970s, never returned to being just another commodity. Uranium, after nuclear proliferation concerns, never traded freely again. Food commodities, after global shortages, never regained innocence. Silver is following the same trajectory. And once that shift happens, price history becomes irrelevant. Old highs stop mattering. Old comparisons fail. The market enters a new regime. That regime is defined by scarcity management, not abundance pricing. This is why arguing about whether silver is overbought is meaningless now. Overbought relative to what? A past that no longer exists. The correct question is whether supply can meet obligations. And the answer is increasingly no. This is the final shame loop. You were told markets would adapt. You were told innovation would solve shortages. You were told higher prices would fix supply. None of those claims survive contact with mining reality. Mining is slow, policy is rigid, demand is accelerating. Those three facts do not coexist peacefully. They collide. Mexico's decisions ensured that collision arrives sooner, not later. This is the ticking clock reaching its final phase. The next 24 to 36 months are when allocation replaces liquidity, when private contracts dominate, when visible shortages emerge. By 2026 or 27, silver will no longer be discussed as a trade. It will be discussed as a constraint. That is the moment markets never forget, because constraints reshape behavior permanently. Once users adapt to scarcity, they do not return to casual purchasing. They secure, stockpile, and defend access. That locks scarcity in. This is why shortages feed on themselves. The more people fear running out, the faster supply disappears. Mexico did not start this dynamic, but it accelerated it decisively. By removing future supply, it forced the world to confront limits sooner than expected. And limits are not negotiable. This is the final echo. You were distracted by a rumor about an export ban. The real story is far more severe. Mexico didn't ban silver exports. They ended the assumption that silver would always be there when needed. Once that assumption dies, markets change forever. This is not a temporary shock. It is a regime shift. From abundance to allocation, from pricing to power, from markets to management. Silver is crossing that line now, and once it does, there is no return to the old world, only adaptation. And adaptation in resource markets is never painless. This is not the end of the story. It is the point where the rules change, quietly, irreversibly, and by the time the headlines catch up, the metal will already be gone.